Medium-term outlook is for interest rates in the US to come down. The slight issue at the moment is that as the tone of the central bank has shifted away from hawkishness, the market has very quickly moved towards already starting to try and price in the easing cycle in the US. So in terms of the valuations of bonds, particularly in the longer end of the curve, 10-year for example, a lot of expectations were already getting pricing in, and arguably valuations getting a little bit rich, at least in the near term. But in terms of the medium-term outlook, it is for the Fed to begin to shift towards an easing cycle in the middle of the year. Short-dated bond yields and short-dated rates certainly have room to fall, and that's obviously going to provide the thrust of many different factors. It will allow rates generally to come down. It would also probably result in the dollar coming under some pressure, so that has significance particularly for EM and Asian countries, and it provides a lot of relief for emerging economies that have been struggling a little bit with this elevated and high rate environment, which has obviously constrained and impacted funding costs. So there are actually many opportunities in the Asian bond market. We found value in markets like Malaysia, Korea, Indonesia, Philippines, but there are some aspects of the Indian market that do set it aside. Many of the markets I just mentioned are already part of global bond indices, either EM or actual global bond indices. Foreign investors already have exposure to some of these markets, in some cases quite high. So foreigners own like 20% of the Indonesian bond market, a significant amount of the Malaysian bond market. Very different story in India. This market has not been part of any global bond indices, and the average foreign exposure of Indian bonds is less than 2%. Now, why is that important? If you look at some of the environments that investors globally have been struggling with, very high volatility environments where capital comes out of a large number of markets and correlations between these markets go up, that makes the diversification of portfolios for investors very difficult. By finding these markets that are very well supported by strong fundamentals like India, but markets that investors don't own, you find that they're lower volatility, lower correlation to other asset classes, and deliver a significant amount of diversification to investors. Long story short, investors can build much better quality portfolios by having allocations to something like the Indian bond market. The fact that we're also poised now from the middle of 2024 to see India becoming part of global bond indices means there's a significant amount of capital coming in, and you can already position to benefit from that now by investing into the market. We also see the start of the Reserve Bank of India's inflation cutting cycle beginning probably around the middle of this year, and unlike other global bond markets, particularly US Treasuries, that isn't yet priced into India's yield curve. Probably a key risk, given the sensitivity of the market and orientation of the economy, tends to be around commodities, right? So if we see shocks to oil prices, specifically upward pressure on oil prices, that could be caused by, say, for example, geopolitical risk in the Middle East. That does tend to have a bigger impact on India because it is one of the largest importers of oil, right? The other environment where India may not perform so well is if and when we go back to that classic strong growth environment where China is growing at 6.5% or more, and US and European economies and emerging economies are all growing strongly, providing structural demand for commodities. That will create a lot of inflationary pressures, and so India in that environment also probably won't perform well. As you can imagine, that is nowhere near one of our central scenarios. In fact, it's the opposite. We see in terms of the outlook, the pressures on global growth, the recession risks likely to actually provide downward pressure on commodities. And the flip side is India is likely to be one of the bigger beneficiaries of that environment, where softening in oil prices and food prices will benefit its inflation basket and balance of payments.